All right, my friends, welcome back to Real Estate Bites. This is episode 120. What I want to talk about today with you guys is the tax benefits of real estate. Now, I'm hoping that for everybody, this is just review. But unfortunately, I know that there are probably quite a few homeowners out there, especially if you're young and just bought your home. I'd say within the last, 3 to 5 years, that probably aren't aware of most of this information or any of this information. But if you've watched this program before, that I hate paying taxes, especially to the federal government. If you allow me a minute here to jump up on my soapbox, I hear a lot of friends, family, neighbors complaining about paying RETA, the Regional Income Tax Authority, or their local income taxes. I hate it, I hate it, I hate it. However, they don't complain at all about the gigantic chunk of income that's yanked out of every single one of their paychecks. And the thing, I don't like paying any taxes, but I don't feel nearly as bad cutting my quarterly check to RETA than I do cutting my quarterly check to the federal government. Because when I send my money to RETA, I understand that it's paying for the local police department, the local fire department, the park and recreation programs that my kids enjoy or did enjoy. I know that it's paying for all the local services that my community provides, versus cutting a check that I know portions of it are going to go around the world to arm and kill people. Not a fan of that, So just again, sorry for going off on that rant and that tangent. Nevertheless, there are many tax advantages to owning real estate. And I want to talk about those that are available to homeowners and then those that are available to investors. And I think it's the homeowner that may be a little surprised. Again, I wish that this were a review for everybody, and I'm certain for a lot of people it will be. But there's far too many people out there who aren't aware of any of this stuff at all. So nevertheless, let's jump into it. All right. So for homeowners, you have a number of different tax benefits that are available. Now, what you're looking at here are through the federal government. Some of them are expiring. Some expired the last tax year, 2025. The EV charger one's going to expire here in the middle of the year. But these are federal tax benefits. Now, in the state of Ohio, we don't really have additional tax benefits. You just have these. So nevertheless, the first is your mortgage interest. You take out this mortgage in 2021, 2022, whatever it might be, the vast majority of your payment, if you ever look at your mortgage statement, it breaks down where the monies are going. And so at the beginning of your time in your home, paying that monthly mortgage, the majority of that money is going to pay your interest. It's a terrifyingly small fraction that goes towards the principal. Now, the further along you go in your typical 30-year mortgage, about year 15, those things start to balance, right? And beyond, now as you're heading towards the edge of that 30-year mortgage, the majority of your payment goes towards your principal. But at the beginning, especially those first 10 years, most of that money that you're paying in your mortgage goes to pay the bank off for their profit and that interest. And it takes quite a while to get into paying down that principal. All right. That said, that money that you're paying, when you look at that balance or your monthly mortgage statement, and you see what's going towards that interest, all that money can be deducted from your tax liability. All right. So if you're using TurboTax, right, they point that out to you. And, but if you're going to say, I don't know, an H&R Block or one of the other big tax services, and they're hiring Billy right out of college, or maybe it's, Aunt Susie who retired from her job for many, many years, and now she wants to make a little, extra scratch because Uncle Stu isn't doing so well. And so she signs up to be trained as an H&R Block tax person. She may or may not know what she's talking about. Bill, right out of college, may or may not know. They're being trained as experts in the H&R Block tax software. They're certainly not tax accountants or tax attorneys. They're being trained on how to use the software. So just understand, if you're not being asked by your H&R Block representative for the statement from your mortgage service provider regarding your mortgage interest, they're not helping you out. All right. So that's the first one. Your mortgage interest is tax deductible. Capital gains, if you sell your home, and this only counts if it's a primary residence now. If you sell your home and if you're single and you make $250,000 or less in profit from the sale of that home, all that money is tax deductible. You go beyond that, you start to get taxed, right? If you're married and you sell your home, the threshold is up to $500,000. All right. So the next one is the energy efficient home improvement credit. So now this goes towards any home improvements that you might make that are energy efficient. So some of the projects that you may do that count for this are new energy efficient HVAC systems, heat pumps. If you put insulation in your home or some air sealing in your home, energy efficient exterior doors, anything to make the house more energy efficient. And whatever you buy, whether it's appliances or new HVAC systems, the doors, whatever, they're all going to come with an energy efficient rating. The representative whom you're buying from should know that they have energy efficient value and should be tax deductible. Now, that said, you get 30% of the project cost up to $3,200 is tax deductible. All right. So again, if you do, let's say your home improvement project is $32,000. That's tax, that's an energy efficient program. Well, you're only going to get 10% because that's up to that $3,200 in tax deduction. Nevertheless, if you do a home improvement project that's energy efficient, you do get a tax deduction. Next one on this list here is the residential clean energy credit. This counts if you do solar panels plus a battery. You got to have the battery to store the energy or it doesn't count. A geothermal system, geothermal heat pumps, something like that. If you're creating energy or heating your home with one of these clean energy systems, you get a deduction there. And then finally, what you see there is the EV charger credit. So you buy that Tesla, you install a charging unit in the house, you can get a credit up to $1,000 for each charging unit that you install in your house. Now, as you see here, that clean energy credit it ended on December 31st of 2025, and this EV charger credit is ending mid-2026. So if you install these things, if you're going to buy that, if you're looking to buy that Tesla, right, and you want this credit here, get it done before June. If you wanted to get that credit with a new solar and battery install in 26, well, you're SOL. Okay, so the next slide that I got here is for the real estate investor. Now, I would hope that any real estate investor who might be watching this, and I do have a number who watch this, knows all this stuff. If you don't, shame on you. Really, this is for people who might be considering investing, or if you're a high income earner out there and the government just kicks your ass with taxes every single year, real estate investment might be something that you want to consider to reduce that tax liability, right? Because who wants to pay taxes? Especially if you're a high income earner and they're coming and they're gobbling up 40% of your income. Guys, that makes me want to puke. I mean, 40%? You go out there and bust your ass. You put in the time. You got the education. You've earned your stripes, at the workplace. You worked your way up and now you're earning good money. And they're going to take 40% of your income? Oh. Anyway, let's get onto the list here. So you have that rental property. Well, you can deduct depreciation. There's two ways you can do it. One is through a standard deduction, which is so you can take a deduction every year you own that property for 27 and a half years, right? So some quick math. Let's say you bought a rental property for $275,000, okay? All in costs. So every year you own it, you can deduct $10,000 from your income, your taxable income, all right, as the depreciation on that building. All right. Now, there's also bonus depreciation, which last year went from 100% down to 60%. Yeah, but that's something you could take advantage of as well. Bonus depreciation, which allows you to take a greater amount of that money right now. Obviously, your long-term depreciation goes away if you do short-term bonus depreciation, but it's a great way to reduce a lot of monies from your tax liability. The other thing, passive income, and then the treatment of loss in your property. Let me grab my notes here so that I don't misrepresent some stuff. So anyways, real estate is considered passive income, right? And so if you are a part-time real estate investor, so let's say you're a wage earner, you got a W-2, you're on a salary, and the monies that you bring in from real estate holdings is just a small fraction of what you bring in, right? You're not considered a real estate professional at that point. And so you can't claim losses on your real estate holdings like a real estate professional could. Now you can, as long as you are actively involved in managing that real estate. So let's say you invest in a REIT, right? Or you invest in a syndication and you are a wage earner somewhere else, and that syndication loses you money, okay? You can't claim it because you don't actively are involved in the management and the running that operation. Now, if you go and purchase or you inherit a property and you turn it into a rental property, right, and you sustain losses on that, if you're the one who's managing it, right, you place the tenant, you went and found your tenant, you put them in there, you're collecting the rent, you're the one that's calling the handyman when you need a problem, you're the one that's dealing with issues on site, you can claim up to 25 grand losses total for a year, right? Obviously, if you only lose 5 grand, you can't claim 25. You can only claim the 25. But if you lose 40 grand, you can claim up to $25,000 in losses as a part-time real estate investor. Okay. So that's how losses are treated. And that's how passive income works. Now, if you are a real estate investor, right, you can claim as much loss as you incur with your real estate holdings. Now, to be a real estate professional, there's a certain number of criteria that you've got to meet to be considered a real estate professional. So basically, what they're looking at is, do you make your money in real estate? So is 50% of your business revenue generating activities involved with the trades, with real estate, et cetera? Are you working, I think it is 750 hours a year in real estate? If so, you qualify as a real estate professional and you get those tax benefits. The other thing, 1031 like-kind exchanges. So this is something where if you have a real estate holding and you sell it, you can take the proceeds, put them towards another similar real estate purchase and not incur any of the tax penalties today. Basically, you're kicking your tax liabilities down the road, but it allows you to sell and then buy, reinvest that money without incurring a tax penalty today. And then finally, the last one is, and I can't read it because, real estate professionals. Well, we already covered that. The benefits you get from being a real estate professional. All right. There's another one in here, which is there's a capital gains benefit. So if you were to sell your rental property, you're paying capital gains, but the capital gains that you pay would be less than your typical tax bracket. Now you have to be careful because there's something called a depreciation recapture. So when you go and you sell it, your capital gains are less, but the government can come and look at what have they given back to you in depreciation, and they can recapture up to $25,000 of that and tax you on it. Okay. So those are, those are the major tax benefits for owning real estate. I'm not a tax attorney. I am not a tax advisor. I am not a tax accountant, but these are, if you really want to get into nitty gritty and have people look over your stuff, those are the professionals you need to talk to. But this is the benefit of owning or being in real estate. So if you're a homeowner, just to go back and take a quick look, these are the things that you can save money on with your taxes if you're engaged in any of this stuff. Your mortgage interest, capital gains exclusions, energy efficient home improvements, residential clean energy credits, and EV charger credit. If you are a tax professional, you get depreciation deductions. Deductible operating expenses is the one I missed. So obviously, if you own a rental property and you got to put money into repairs, you got to put money into, appliances, whatever it might be, all the expenses that you incur, property management expenses, your property taxes, all the expenses you incur to operate those holdings are tax deductible. All right. That's the one I screwed up on. That's the one I missed. The other ones, passive income, the loss treatment, 1031 like-kind exchanges. And are you a real estate professional? Do you qualify? If so, there's additional tax benefits, mostly in the way that they treat the losses in your real estate holdings. Okay, so that wraps up that portion. Let's get into our stats of the week and then our big sale of the week. All right, share screen. Here we go. So there were 481 single families and single family residences and condos available for sale in Lorain County this morning. Been a while since I covered this. These stats come from the MLS. They are only Lorain County. That's what I'm using as my sample size for basically the Midwest. Things are different on the coasts. We're looking at the Midwest, the heart of the country. So that's what we're discussing here. I use median values because that eliminates outliers. If there's a $4 million home sold, that is very far from your typical sort of home, right? So we don't count the $4 million home. No, neither do we count the $10,000, home that's just been destroyed in a rough part of town. Those outliers are eliminated. The median home is more representative of your typical home, typical values, etc. Okay. So there were 43 homes sold last week in Lorain County. The median square feet of homes sold was 1,470. That's the second week in a row we've seen a rather low median square foot value. Last week we were talking about that was one of the lowest, and this one's even lower, right? Median home value of homes sold last week was $247,000. Median square foot price, we got a big jump back up, $183.10. So as we looked at, this is a value that we have been tracking in real time to see what's going on with prices, okay? We saw the average median square foot value in Q3 2025 was at $175.54. This was after months and months and months of appreciating rising home values. And then we saw a huge correction in Q4. We followed suit in the first week of Q1 2026 with a median square foot value of $166.59. And now we've jumped back up to $183.10. Let's see if this trend continues or if it's a bit of an anomaly here in our second full week of January. Median days on market, 26. Interest rates are continuing to improve. This morning, they were at 6.04% for a 30-year conventional note. The big sale of the week, actually not so big. This is a pretty typical home value in Avon Lake. So sales were funny, but this one sold here in Avon Lake, $550,000 in Windward Way. Let's take a look at it. This is what our big boy of the week was. All right. So this one, what we got here is 4-bed, 2.5 bath, 3,000 square feet on 0.35 acres in Avon Lake. And we'll scroll through some pics here. Let me just make sure you're seeing what I'm seeing and you are. All right. This one spent a little bit of time on the market. As you can tell, there were still leaves on the trees when these pics were taken. All right. Looks like we got oak finishes throughout. these I don't know if you could call those mustard, beige, whatever it might be, but while it looks good, I think had they painted this white, it would have made that room grow a little bit more like this, right? Great, fantastic comparison from one to the other, right? So you've got this look here. The room's darker, feels a little crowded, versus this, where the room really opens up. This is a smaller room, obviously, but you see how that white brightens the space, makes it feel like it opens up a little bit, it enlarges. Okay, so as you can see here, we talked about these things all the time. Some of these older finishes, this is all circa somewhere between 1990, 2005. These finishes, you got the dark cabinets with the smaller hardware on here, the tile floors that are sort of uniform in the tile size and placement. Anyhow, opens up into the living room, some built-in stuff there. So had this been updated, I think we could have seen this value improve by an easy $100,000 here in this neighborhood. Easy. Yep, for sure. Maybe even a little bit more. So anyways, we're going to wrap it up here. Again, guys, if you like this information, you find it valuable, and you should, especially when I'm talking about saving you money, right? Or finding a way to make more money when you sell your property. If you like this information, if you got people in your life who like this information, please share it, okay? Another thing, if you like this and you want to see more great topics that we talk about here on Real Estate Bites, right up here in the corner, snap that QR code. It'll take you to my YouTube channel. So we talked about tax benefits this week. We're going to talk about rebates from the state next week on your real estate or your utilities or whatever. What's available out there that you should know of. All right, that's next week. Tune in, share this stuff. As always, take care of yourselves and take care of one another. I love you, people. I'll see you next week.